Okay, welcome back. Hopefully you wrote your entries down for December 31st, 2016. So, again, I'm going to talk you through it in case any of you are still struggling with it a little bit. So, what's happening? We're getting cash. So, debit cash, and keep your little table handy from the last page, page 6. Cash is never going to change. What is going to change is the interest revenue. So we're going to credit interest revenue for 33178. And we have to credit our investment fair value net income for the amount of the premium amortization. So 4262. And again, that's the December 31st, 16 line on the last page. Okay, so we'll put that 4262 in our little chart, which means we have a balance of 329238. And what do we have to do? We have to write it to fair value. So, what did they tell us the fair value is? They said at at the end of 2016, the bonds were priced at 85.5. So 85.5 times 312, like we calculated on the other page, is 266.60. So 266.760. We need to bring the balance down to 266.760. So, is it going to be debit or credit? We got to bring it down. So, it's going to be a credit of 62,478. So, we just did this. Did 329,238 minus 26760. And when you're showing your work here, that's the same thing. Not that you will be showing your work to me. Okay, so we're going to debit. This is a gain or a loss what's going down. It's a loss, unrealized loss of 62478. And fair value through net income 62478. So now you can go ahead and do the last two. I will just tell you the answers so you can check them. So 2017, there was a gain equal to 9368, and 2018, there was another gain. And I'll just fill this in for you so you can see what happened. And that's how it should look. So just take and write that down, and your entries would be the same. They'll either be with a credit to the investment or a debit, like up here, depending if it's a gain or a loss. Okay. If you've got that, hopefully you do. I guess you could have just hit pause. Let's go on to page 8. So we just finished doing 2 examples between these last 3 videos. One of equity investments, so buying shares of another company, and this one was buying a bond. And we were using fair value through net income. Every year you mark it to fair value, and everything goes through net income. Okay, so you notice what I mean by that is interest revenue goes through net income. It's not interest revenue OCI. Okay. So on page 8, we're going to look at the last model. Fair value through OCI. It's only valid under IFRS. ASPE does not have fair value OCI. And it's used for investments in equity instruments where they've specifically elected as not be held for the purposes of trading. Allocating to FVOCI is irrevocable. They are listed as current or long-term assets. And you can switch, but going from FVNI to OCI, you can do it once and never again. At acquisition, the equity investments are measured at fair value, including any transaction costs. This is the big difference between through net income and through I, besides, of course, the OCI gains or losses. So at each reporting date, so the end of the year, end of the quarter, measure it at fair value. Unrealized gains and losses are going to go into OCI. And from OCI, they will eventually end in accumulated OCI, which is a balance sheet account, in shareholders' equity. Now, how they get there is, because we've only been doing this since 2011, and the OCI has been used, also hasn't been used, so there's no set way of doing it. I personally would close OCI into accumulated OCI. Others, like this text, have a retained earnings. It goes to retained earnings and then goes to OCI, accumulated OCI. Anyway, I really would like to stay consistent because, of course, 10 text, which is advanced, when you do this kind of stuff, because you're going to be doing this again, just to review, it's got a different way of showing it. So, and what I've seen, they don't show closing entries and stuff on financial report, but it just goes OCI to accumulated OCI. Anyway, that's all beside the point. I will clear what you have to do for Wiley. Right now, when I go through this, it's looking just like Wiley Plus. Everything ends up in the same place, and the statements look identical. It's how they get there that's a bit of an issue. Okay? So I'm going to match Wiley Plus. And if there's a change in Wiley Plus because of my conversation with them, then I'll let you know. Okay. Dividend and interest income are recognized separately usually. Now, gains and losses will either be transferred or recycled into net income with recycling or transferred directly. The new standard does not allow recycling, so we're not even going to show it. Now, you guys that are working right now or going to work soon, you might see the recycling because the standard just changed in 2018. So if you're looking back, you'll see it to be a little bit different. Assume recycling unless the question tells you otherwise, but most of them tell you otherwise. Okay, so this question is almost identical to example 2. So we made the following Granger this time. Following purchases of investments during 2020. January 15th, we purchased Lee, and it's got a commission still. April 1st, Richard, and September 10th, we bought Extreme, and there was a dividend. And then they sold $31.50, $37 minus brokerage commission. Values per share were these, and they follow IFRS 9, irrevocably elected to count them as fair value OCI, no recycling, separate reporting of dividends. Okay? And other gains and losses. So again, we're going to do the journal entries to record the 3 investments, and then the sale on the 20th, and then the adjusting entries at the end. Okay. Well, let's get started and see how long we go for. You get close to my cutoff. The double keyboard cuts you off randomly between 14 and 22 minutes. And I don't know why. The size can be different. It's not only the size. Okay, I'm talking too much. Okay, let's go to page 8. Page 9. So, we bought the investments on January 15th. Bought Lee. So, with these, the transaction costs are capitalized. Not expensed. So we're only going to see debit to investments, a VOCI, and a credit to cash. And that's it. So our cash, we said there were 94.50 shares, and just follow along on page 8, times 35.18 plus the 20.79. So, like we did in the other one, it's 334,530, and this also is 334,530 because it's capitalized. It goes right into the investments account also. Okay, so that's the big difference between the two, and of course it's FVOCI. Now, on January 31st, we got dividends from Lee. So, we get cash, and it was 94.50 times 1. And it said the items are recorded separately generally. This time we lumped everything into investment income and loss, but this one's going to be separate. So this is dividend revenue. So just take a sec and go back. I'm just going to find the right page. Yeah, look on page 5 of your notes. Did you notice here? So on the bottom is the FV through NI. It all went, the dividends went to investment income loss. Now it didn't have to, they could record it separately, but for that question they didn't. This one, it said everything's recorded separately, so it goes into a separate account. So that's 94.50. Now April 1st, we bought Richards. So we debit investments. And credit cash. And that is going to be I didn't show my calculations. 52.50 times 55 plus 3,539. And so that should work out to the same as the other question. 2922 89. So 292289. And then September 10th, we buy Extreme, debit, investment, FVOCI, and credit cash for 7350 times 2783 plus 3056, which is 207. Okay. So that's all the purchase entries. So now, May 20th, sell a portion of Lee's shares. Now, because this is fair value through OCI, it's slightly different. You have to do two extra little steps in here. So the first thing you're going to do is write the portion of the investment you're selling to fair value based on the proceeds you will receive, less any transaction costs, because we need to separate them here, and use unrealized gains or losses OCI. That OCI thing has to be there. Okay. Second thing you're going to do, let's color code these, shall we? Second thing you're going to do, record the sale of the investment, or of the investment. There should be no gain or loss. Now, technically, you could combine these steps, okay? I recommend don't, because what happens with students combining, especially in these early stages of your career, is you end up combining this unrealized gain or loss with the actual realized gain or loss from selling. So it can get a little crazy. Okay. Anyway, part 3. And this is where having a difference of opinion with the text. We're going to assume unrealized gains and losses have been closed to accumulated OCI. Okay? So we close, oh, sorry, that says to retained earnings, you guys, sorry. So assume unrealized gains or losses OCI have been closed to retained earnings. So we close retained earnings to AOCI, which is just like retained earnings, except it's only for OCI accounts. Okay, and this is no reclaim. And don't worry about recycling. It's not going to ask. Not going to test recycling because it's not in use anymore. Okay, think my time is probably up. Oh, the wording Wiley Plus uses for that. So Wiley Plus says transfer the holding